Hey my awesome people, welcome back. So much action since the last time I've seen you and so many developments to digest. I've got a lot of research to share with you today. I just recently put out a new article on Seeking Alpha on the latest developments surrounding signs of progress in US-China relations. But just as things were getting better in Chinese tech, the NASDAQ and the S&P 500, we have a new issue in the market. And this time, far more important than Evergrande, in my opinion. Now, I know that the market narrative shifts quickly, and recently, investors are now once again focused on the 10-year yield. And this is a serious market development, so I encourage you to learn as much as you can from this video and comment down below if you have any thoughts that you want to share. So I want this research video to serve as both investment strategy and also some evergreen educational content for you in case that you want to refer back to it later as a guide for the future. So bookmark this video so that you can refer back to it later. So in today's research piece, I'm going to answer a couple key questions that will essentially help us form an opinion on where US and Chinese equities are going next, and answer that dreaded question, when is Chinese internet going to bottom, and will the S&P 500's bull run continue? So here's what I'm going to cover today. I'm going to talk about the first consideration, and that is the relationship between the US and China improving. And I'm going to talk about this in great detail, what this means, and where we could see Chinese internet in the months ahead. In the second consideration, I'm going to talk about why the 10-year yield's rise is very important to follow and what that means for investors who are positioned in the S&P 500, Chinese tech, or the NASDAQ. And after I talk about all of this, I'm going to talk about what I plan to do based on this current market environment. Now, before we start, I just do want to say that from my experience as a researcher and CFA charter holder, that the 10-year yield, in my opinion, is far more significant on the market than the Evergrande situation. The 10-year yield can literally hold the market hostage and stop rallies from progressing, especially in the tech sector. In other words, the weakness that we've been seeing so far in technology needs to be treated with far more caution. I would be a little bit more hesitant in buying this dip until I see signs that the 10-year has stabilized, because it can be a very strong inverse relationship between yields and stocks. So I would encourage my friends on YouTube to not be overly aggressive in this environment. I would encourage my friends on YouTube to, if you want to buy the dip honestly, stick with ETFs that have broad, diversified sector exposure, like DIA, SPY for the US market, or FXI for the Chinese market. I would say that it's a little dangerous to buy individual tech stocks if you haven't really done a full-blown DCF analysis on them, because the 10-year yield represents the discount rate that discounts their future cash flows. And it's one of the most sensitive factors in Wall Street models. Now, to ensure that the 10-year yield doesn't get out of control, that it behaves, stays in that 1.4, 1.6 healthy range, and it doesn't shoot above 2% and cause this massive sell-off, we really do need to hit that like button so that my video gets shown to more people, and even at our friends at the Fed, to give the markets more positive messaging. And most importantly, share this video with friends, because it'll be educational and it will benefit both you and them. So let's get started. The first research point that I'm going to talk about today is my observation that the US and Chinese relationship is improving. It is improving, and I'm really excited to talk about why. And this honestly will answer the question and drive the future of where Alibaba, Tencent, and the core ETFs KWEB, CQQQ, and FXI are going next. If you've been a subscriber to my channel, or you've been reading my research on Seeking Alpha, you would know that I am a huge believer that the continued cooperation between US and China will honestly benefit everybody and extend the life of the bull market in both the US and in China. Really, everybody wins when cooperation is solidified. So to give you a sense of where US and China, in terms of their relationship, is today, I want to give a timeline of some structurally important events that have happened in the past 18 months or so. So as we all know, former President Trump's hard line on China started really when he began the trade war, and that really intensified with the harsh rhetoric on the origin of the coronavirus back in 2020. Now, that was then, and this is now. There was hope that President Biden, who was sworn in this January, would attempt to repair Chinese-US relations. Instead, the relationship has continued to deteriorate, and I want to list 3 major events from this year that you want to take note of, which in hindsight would have told us that Chinese stocks would have been under great pressure for the rest of the year until perhaps now. So let's revisit the March 2021 Alaska meeting between the US and Chinese delegation. Now, in this first meeting since Biden took office, the meeting in Alaska in March with the US and Chinese delegation unfortunately was unproductive to say the least, and actually might have caused deeper structural issues to come. And I wish I saw this coming so that I could have alerted you earlier this year, but I do think that this might have caused Beijing to later do a reset of foreign capital out of its system. And at this highly contentious March meeting, the US and Chinese delegation had deep disagreements, and both sides couldn't find any real common ground in the discussions. And it was widely quoted that a highly ranked politician, Yang Jieqi, said that the US is not qualified to speak to China from a position of strength. In my opinion, that quote was a very, very strong message to the US delegation that China intends to protect their interests at nearly all costs, and consequences could come if there's any interference. Now, here's where the investment analysis comes into play. If we think about what happened between the time frame of March 2021 and the next meeting in Tianjin, July 2021, during this time, right, from March to July, China unleashed this wide slew of new regulations this year in multiple sectors, ranging from education to the Chinese internet sector. Now, while I'm sure most analysts will say that these regulations were a part of China's 5-year plan, I'm now convinced that Beijing accelerated these regulations to modify their financial markets to fend off foreign capital and foreign influence. As an example, the private educational after-school tutoring market in China, before the regulations from earlier this year, attracted a significant amount of foreign capital, a significant amount. This essentially means that foreign capital plays a pretty big role in how Chinese private education is shaped and how it's curated. Now, given the skepticism now towards foreign influence and foreign ideology in China, I hypothesize that China targeted the after-school tutoring sector as one of the first industries to flush out foreign capital. And after doing some deep reflection from my previous research videos that I've published on my channel, you can see that one of the new regulations is to forbid foreign capital investment from investing in private Chinese educational companies. I think that these regulations are directly tied from the, I would say, unproductive meetings that the US and China held back in March. Those contentious, very, I would say, unhelpful meetings. Now, of course, the typical narrative that we've seen up until this point is that there is a very challenging demographic composition in China right now, and that's for sure very true. There is an aging population, and with the birth rate decreasing, it would be difficult for China to position itself to lead the world's economy without the right demographics. That, of course, is very important. But here's the thing, the swiftness and the intensity of causing an exodus of foreign capital since the March meeting tells me that this move potentially could have been inspired from the poor outcome from that Alaska meeting. And it serves as a reminder to foreign investors that they really can only make big money in China if there's continued harmony. So as a result of this, I believe that this year's tech sell-off is not simply regulatory oversight. It's a direct response to shoring up China's future infrastructure to compete more effectively in the future. After all, when we think about it, right, all the big money, all the institutional investors, like how could they have been caught flat-footed with New Oriental and TAL? Look at this chart where essentially there's this cliffhanger, And that implies that very few institutional investors saw this coming from a fundamental analysis perspective. And because they were caught off guard, they quickly sold first and asked questions later. And you can see that the Chinese internet sector has really borne the brunt of the heat. Now, a couple months later, July 2021, the Tianjin meeting. In the second meeting of this year, the US delegation led by Secretary of State Wendy Sherman and China's Foreign Minister Wang Yi, China included a list of US wrongdoings that must be fixed. This list is really, really key, because if you have this list in your notes, in your radar, and you can see in the news that these items are being addressed and these items are being fixed, I'm nearly confident that a huge rebound in Chinese internet will come. Now, let's take a look at this list, which includes several requests, ranging from revoking visa restrictions, revoking sanctions on Chinese leaders, revoking the extradition request for Meng Wanzhou, which, by the way, was successfully done, and I'm going to talk about that. Stop suppressing Chinese enterprises, and revoking the registration of Chinese media outlets as foreign agents, right? When we monitor this list, if we can see public news that these items are slowly being walked back upon, that will give me a lot of confidence to put even more capital to work than I have now. Now, unfortunately, from the July 2021 meeting, the outcome of this meeting was also tense, and it was also widely considered to be unhelpful and unproductive. And what happened just the next month in August, we saw short sellers making incredible profits from shorting Chinese tech as sentiment was still getting depressed with no signs of improvement. Now, this is very key, because we can see this year that onshore Chinese equities, represented by the Shanghai Composite, has honestly held up really, really well, whereas offshore Chinese equities, listed as ADRs, those are the share prices that have seen the brunt of the depreciation. So who holds a lot of these offshore equities? Foreigners, right? Like perhaps you and me. Foreigners who are really now experiencing the outcome of unfavorable US-Chinese relations, which, by the way, is quickly improving. So did that Tianjin meeting go well? Not really. So are we starting to see the pattern here? Alaska, March, didn't go well. Chinese equities sold off. Tianjin in July, did that meeting go well? No, Chinese equities sold off. Now, fast forward to September 2021, where President Biden and President Xi have a phone call. I believe that call was to calm the tension that had been building up from increased military presence in the Taiwan Seas. And as I've mentioned in previous videos, I believe that the Taiwan question continues to be a very important consideration in US-Chinese relations. Now, the latest news is that Canada has released Meng Wanzhou, and in return, China has released 2 Canadian diplomats to return home back in Canada. This is an incredibly important positive development, because this marks concrete actions from the July Tianjin meeting, where China expressed the desire to have certain items be addressed concretely. Now, it seems that this event with Meng Wanzhou and the Tianjin event was actually discussed on the September call between Biden and Xi. And it was released in the Global Times that confirms that Xi urged Biden to resolve this incident in order to calm relations. This development, in my opinion, was almost certainly the reason why Alibaba and Tencent temporarily saw this reclaim of its share price for $150 and $60 for Alibaba and Tencent this past Monday, which was the day after the news went public on Wall Street Journal on Sunday. I view this as a really good step in the right direction, and with Chinese equities and their valuation at multi-year troghs and this nail taken out, I believe that investors who have the right time frame, the right risk tolerance, and right perspective could find some serious alpha if the timing is right. Now, of course, the US-China relations is still strained, but markets climb that proverbial wall of worry. So if someone is really risk averse, then I do say you should wait for more clarity to emerge before starting any positions. Now, to round out whether there is an improvement in the ongoing relationship, I think that the answer is a clear yes. Just like in March, where we got a clear confirmation that US-Chinese relations were clearly deteriorating, and in July where they got admittedly worse, we now have a step in the right direction. So this could be the beginning of the turning point for Chinese internet for at least a stabilization period, for at least a consolidation period, before seeing any upside. Now here's a chart that hopefully I think will be very helpful to illustrate my analysis to you. You can see from this table that I've detailed out the major events that have happened this year. The Alaska meeting, the Tianjin meeting, the Biden and Xi phone call, and the Meng Wanzhou release date. And you can see that I've listed the time frames under these events. So Alaska was between March and July because Tianjin was the July event. And then the next time US leaders spoke was in September. So that explains all the time frame details. You can see here that from this table that because Alaska and Tianjin and the Biden and Xi phone call were unfortunately not very productive, in fact, they addressed more issues than things that were resolved. You can see that I've analyzed the max drawdown for CQQQ in the 30 days after the event. And you can see that after Alaska, there was a max drawdown of 9%. After Tianjin, there was a max drawdown of 9%. After the Biden and Xi phone call, there was a max drawdown of 10%. So what that implies is that these events between US leaders and Chinese leaders need to be widely followed. And any positive development can potentially turn the tides. You can see that from the time that Meng Wanzhou got released, the max drawdown for the CQQQ, I know that it's only been a short period of time, the loss is much more shallow. And hopefully, as more positive developments come out, CQQQ, along with the general sector, will see a rebound, okay? Awesome. Now, up next, I do want to talk about a more imminent risk to the market for US investors specifically, and that is the 10-year yield. Now, for my followers who are beginner investors, know that the principle is this, that when yields increase, when bond yields increase, more capital is attracted towards bonds as it is guaranteed income. The 10-year yield is essentially a risk-free rate, and this takes away capital allocated to the stock market. So higher yields are generally bad for the stock market unless the economy is booming. Now, for my followers who are more experienced, I want to share with you my more nuanced thinking as it relates to the 10-year yield. So let's just first revisit why it's important. So we all know that Wall Street equity forecasting models use the 10-year yield along with the company risk premium to discount future cash flows for companies. And it also happens to be a proxy for inflation expectations and also future economic growth. So for that reason, the 10-year doesn't have a black and white definition in real investing. And it's really an ambiguous metric that must be treated as more of an art than as a science. Now, this is a really key insight that I want to share with you. Economists, Wall Street figures have analyzed what have killed bull markets in the past, and honestly, it's a very short list. Now, included in that short list are higher rates and inflation. So you want to note that higher rates and inflation can absolutely derail a bull market, and this is what we're starting to see today, so caution is truly advised. I'm naturally very bullish on the stock market because we don't have a lot of options around us in terms of where to park our capital, but the environment that we're in today truly warrants caution. So unless you are really into picking specific companies, I do think that broad-based ETFs are definitely far more safe. Now, here's the thing. The 10-year is especially important for long duration assets. So that's a fancy term for companies that expect to derive their cash flows far into the future. And the technology sector is an example of long duration assets because these companies, their cash flows are derived far into the future. They could be not as profitable today. So that means that the tech sector is going to be especially sensitive to the 10-year yield and any steepening in the yield curve. Now, we can see that from earlier this year in the spring, when the 10-year yield spiked to 1.7, 1.8, the NASDAQ got hit the hardest, and there was a really large rotation from growth into value. And from my previous video where I mentioned that the S&P 500's top 10 stocks are filled with technology names, and this group makes up nearly 30% of the index, it makes it very difficult for the S&P 500 to appreciate without the support of the tech sector. Now let's take a look at this table that I constructed for you. You can see that in the time frame spring 2021, when the 10-year yield quickly rose from 1.1 to 1.7, the NASDAQ sold off very close to 10%. And this fall, actually, in the last couple of weeks leading up till now, when the 10-year was going from 1.1 to 1.5, the NASDAQ is now off 4 or 5% from its highs. Now here's what's up for debate. Why is the 10-year yield rising, and how much damage can it actually do? We can see that the 10-year has been steadily rising since the Fed meeting in September, after Jay Powell announced that the taper is coming and the timeline for rising rates could come as soon as 2022. Now let me show you some really critical details from the latest Fed meeting so that you know exactly how to interpret the current situation from primary sources. You can see that from the press conference, Jay Powell believes that the time for tapering has come. And he says that moderation in asset purchases are coming. Now, just some history for you. Back in 2013, when Ben Bernanke started the tapering process, the S&P fell nearly 7%, and Ben Bernanke actually needed to hold the tapering process until several months later, and because he held that process, equities actually rebounded very strongly at the end of the year. The time frame was very similar as well. He made that announcement in July 2013 that he would taper in September. In September, he held off tapering, and the S&P recovered into year end. From July to September of 2013, though, the S&P fell anywhere between 6 and 7%, which was pretty severe for US investors. Now, we can also see from the latest Fed meeting in September that the dot plot has some very important information. The forecast shows that the GDP got revised down for this year, but got revised up for next year. Now, inflation got revised up for this year and also up for next year. Inflation is now at 3.7%. The Fed looks at the core PCE. Now, unemployment got revised up for this year and is flat for next year. Now, let me connect the dots for you so that you can see the risk. The Fed makes interest rate decisions based on two primary considerations. The first is labor market conditions, meaning unemployment, and the second is inflation expectations, hopefully anchored at 2%. Now here, inflation is higher than expected, but unemployment is also higher. So from that playbook, that means that the Fed cannot make a move today. They cannot make a move right now, and very likely until inflation is around 2% and unemployment is around their target, they can't raise rates. Here's the real risk. If inflation is structurally higher and the job market temporarily improves over time, but the Fed raises rates at the wrong time. In other words, the rate hike does not cool off inflation, but it ends up hurting the job market. That's a situation when it would be a complete warning sign or disaster for equities. So make sure to keep that in mind. If the Fed raises rates, but it does not cool off inflation, and it hurts the job market, meaning that inflation is still like an issue and they have to raise rates even higher, that is a really very dangerous market environment. So I urge caution to closely monitor the 10-year yield to consolidate and stabilize before buying any dips in technology. That's exactly what happened earlier this year. The 10-year just kept going up and the market kept going down. The moment rates stabilized, though, the markets recovered. So be patient here. It's very important to be patient here. Now, The one item that continues to reassure me is that the Fed is still data dependent, and they did say that in their press conference they're willing to reassess their position if they see any risk to the outlook. That's a short way of saying that they do support equity markets at this time. So as long as Jay Powell is reappointed for a second term, I have a lot of confidence that the Fed will do the right thing for the stock market. Now, for those of us who are a little bit more advanced, you're probably wondering, where will the 10-year yield go in the short term? Let me help you understand what are some drivers behind how the 10-year is going to move. The 10-year is a function of inflation expectations, and the Fed monitors core personal consumption expenditures, short for core PCE. And we need to monitor several economic metrics that hint at inflation, like housing prices, commodity prices, oil prices, auto prices, input costs from raw goods, and even China's latest power shortage and how that could affect production and therefore global input costs. I suspect that the latest rise in the 10-year yield is somewhat connected to China's latest power shortage. So make sure you keep an eye out on that, because that could cause inflation in the short term. So from all of this, here's what I believe. If you have a really strong conviction that rates will stabilize, you'll find a lot of alpha by allocating in tech. That's what I'm doing. I'm a little bit more aggressive in this area. However, if you want to buy the dip more safely when rates are rising, I think that broad-based ETFs like SPY, DIA, or FXI far, far more safe. And you can honestly do very well just buying the ETFs for a general market rebound and miss any underperformance if you happen to pick a more rate-sensitive name or sector. So with that said, the comments below are open for discussion, and if you want to connect with me on Instagram, make sure to feel free to follow me. And once again, I'm building an email list for early next year. I expect to send out informative emails to this list every once in a while as a high-value, low-frequency read. If interested, the link is in the description below. And just like my content, it'll be high-quality research, and as a result, it will be infrequent. So with that said, stay safe, and here's my tactical summary for you, and I will see you next time.